Welcome back to Sidekick TV. In this series, I'm joined by Grant Davies from Hamilton, Hindin, Greene, and Ben .brinkerhoff from Consilium. In this series, we're talking about the many points of the investing landscape, of time in the market, Kiwisavers, and particular shares and behaviours. What I'd love you to do is take learnings from these videos and enjoy, but please do remember there is absolutely no personal tailored advice in these videos. So if you do want to take action, then please do engage with one of the advisors. Many thanks. Please enjoy. Great, so in this video, you may be familiar with Grant and Ben now if you've watched any of the other in this series, but in this video, we want to be talking about what is risk and how much should investors take. So the floor is yours, gents.
Yeah, well, I guess risk is something you see on the news every night, isn't it? They only really talk about the share market when risk is in play. But in the short term, it's really just volatility. And obviously, as you zoom out, the volatility disappears. And you're left with a nice little line that, by and large, goes upwards. But that doesn't make you feel any better when the market's going down, of course. But the ebb and flow of the market's all part and parcel. And I don't think you should be thinking of it as risk as such. But volatility and finding the right level of risk, I guess, for yourself that makes you comfortable is probably the key point there.
I kind of think of risk based on what Grant was saying as almost these two separate things. One is, risk is the uncertainty of the price of my portfolio tomorrow. How certain am I that I know what the price is going to be tomorrow? If it's it could be 1 or 2% different. That'd be quite risky, actually. Or it could be with pennies different. That's quite certain. So that's one element of a risk. It's uncertainty about prices, right? Now it turns out, the more uncertain I'm willing to be about prices, I get something else back, and that's a second element of risk, which is how certain am I that I'm going to achieve my financial objectives? How certain am I? Now, it turns out, and this is the cruel irony of this, right? It turns out the more uncertain I'm willing to be about the price of my portfolio tomorrow, the more certain I get to be about achieving my objectives in the long run. And it's the trade-off between these two things that really does people's head in. Yeah. Because if you focus on, I want to be really certain about prices tomorrow, well, you're going to be in cash. Yep. You want to be certain about prices tomorrow? Going to be in cash. Cash is pretty certain about what prices are going to be tomorrow, right? But a cash portfolio is really going to struggle to achieve your goals. Yep. If you're in a share portfolio, what could the shares do in a single day? 2-3% on a big day, up or down? So I may not know it, could be in a year. On a good year, up 30%, a down year, down 30%. Those are possible numbers. Not very common, but absolutely possible. But over the long run, I'm much more certain to achieve my financial goals in a portfolio that has that kind of price uncertainty. And there's conflict between those two things.
But there's all the evidence to support it as well, I presume.
Absolutely. Well, you have capital market. Capitalism, I don't know what people think. There's entrepreneurs, right?
Yeah,
you like capitalism. Good. Capitalism it's been proven over a long period of time that what happens is that companies solve problems. They take a portion of the profit to solve the problem, and they give the rest of the benefit on to consumers. Mm-hmm. And you know what? World is not out of problems. Right? There's plenty of problems that business owners are trying to solve. And so I think we can be confident in the long run, as long as that incentive to solve problems and share the benefits with society exists, that businesses over time will grow in their profit. That is, so as long as you have some confidence about that, then investing in business should be something that over the long run, you feel very safe about.
Yeah, absolutely. I guess the other thing, when you're talking about the cash, you're certain about what it's going to be tomorrow. But if you've got 30-year time horizon, you being in the market's the only smart place to be. I guess you can have the best conservative asset manager in the world and put him up against the worst aggressive asset manager in the world, and over a 30-year period, the aggressive asset manager is going to win.
It's going to win.
It doesn't really matter what that conservative asset manager does, because they're limited to being conservative, and so. Well, I wouldn't want to bring up the worst asset manager, of course, because certainly not here. But yeah, finding that right asset allocation, and the problem we have in New Zealand is we're probably reasonably conservative by our very nature. Maybe not the people watching this, because for starters they're watching this and they're entrepreneurs and business people, so they may be a little bit more aggressive. But overall, we're quite a conservative country, and we tend towards more conservative investments than maybe we should.
Especially if you're a buyer. And I think that's the thing that people need to figure out right away, right? Are you a buyer of investments? So if you're investing regularly into Kiwisaver, you're a buyer. You're a buyer. You're buying all the time. Are you a buyer or are you a seller? Now, I don't have to explain to this audience that when you're a buyer, you generally want low prices. When you're a seller, you want high prices.
Yeah.
So the psychological trick with that is, if we're talking to people that are business owners, they're probably buyers. So I'm going to take it for granted, and that may not be totally true, that most of the audience here are buyers. They are net buyers of investments.
Yeah.
Okay. So in that world, the logic of investing very aggressively is very sound. Now let me see if I can put some nuance onto that. Imagine a world, right? Imagine a world in which you are investing $1,000 a month into a managed fund, an S&P 500 type fund, or something along those lines. Now, every single month for the first 12 months, markets fall till they bottom out at negative 30%. The next 12 months, markets recover back to even. So I've over that 24-month period, I've been investing $1,000 a month, and the market's done nothing overall, right? I'm just back to where I finished. Now, in that whole time, every single month, naively perhaps, because I'm a buyer, I'm just buying $1,000 a month, like maybe out of my Kiwisaver, just buying $1,000 a month. What would my return be over that whole 24-month time period? Well, my return would be about 17.5%. Now, the market did nothing, but I earned 17.5%. Now, how did that happen? Because I bought more shares at low prices. Because when I put my $1,000 a month in and the market was down 30%, I bought a lot of shares that month. And it was back to even. I bought less shares. So I'm automatically buying more at the best possible time to buy, right? So what am I trying to convey? And we'll put this up in a chart. Hopefully you're looking at it online. If you want to check the math, please check the math. What am I trying to convey in that word picture? I'm trying to convey the idea that when you are a buyer and the markets just go badly, every day you're picking up the newspaper and prices are lower because economic news is poor, and you got to be thinking to yourself, this is horrible, like my portfolio is going down. You should be going, woohoo! It's like sale day at Briscoe's, right? It's all, Briscoe's is sale day every day. But it's everything's on sale, and I'm a buyer, I'm happy. Now my mom and dad are sellers.
Yeah.
So they shouldn't be in my portfolio, right? Because they need to be in something that has cash and term deposits, and along with some growth assets, but something that's quite price stable for their consumption and spending over the next couple of years. But that's on my portfolio. Yeah. If prices go down and I'm a buyer, I am better off.
And that's where Kiwisaver is fantastic, right? Because it just keeps going in. It keeps going in and every month, and it's just regular contributions keep piling into the market. And outside of Kiwisaver, it takes more discipline to achieve that, because you've got to make that active decision to buy every time. And investors are terrible at that. Everyone wants to buy when the market's going up. No one wants to buy when it's going down. The psychology of investors, there's been a lot of work on that over the years, and I don't know if they've really explained it very well, but it's the opposite to the Briscoe sale. You go in there and it's like, right, why would I buy the 50% off? There must be something wrong with that Tupperware. So Kiwisaver is perfect for that because it just keeps on plugging away in the background. You keep buying more and more of the cheaper assets, and if you zoom out, eventually that market's going to recover and start ticking back up again.
I suppose for people thinking this, that works providing the market comes back. But that's so someone might do that with an individual stock, and an individual stock may crash to nothing. And it turns out all of the tips I got on anything Australian mining, not good tips. But
not from me, by the way.
These were unqualified people. If you're in a managed or a S&P 500 or something like that, these things, it's the average, isn't it? It does bounce back.
And it comes back to Ben's point about capitalism before, is that the very nature of it is looking for problems to solve, creating wealth from the bottom up. And the new companies will come in, and they'll come into the index, and you'll get exposure to that company as it comes through.
I like to say, any business can go out of business. But business will never go out of business.
Yeah.
And when you're hedging, when you're an entrepreneur and owning a business, you are hedging by investing into your Kiwisaver, whatever you're investing into, and saving on the side, you are hedging against the success of your business. Because your business may have a bad outcome. But if you're investing into a diversified portfolio, especially one arranged by a professional advisor, well, that is owning, could be hundreds or thousands of underlying businesses that will not all be failing, right? There'll be market cycles, right? But in the end, it will come back. And in a ridiculous scenario where everything went out of business, well, it doesn't really matter anyways. Right? People say you need a gun, but where are you going to go buy bullets, right? Every business has failed, right?
Yeah.
So no, I don't think we need to worry about that kind of scenario. What we need to think about is business itself. If I diversify my portfolio, will always over time succeed. And that reality, why uncomfortable for some people that don't understand business and are not in business, those of us that are in it and understand the nature of it, it's about the surest bet there is.
Yeah. So is there any other parting advice for someone when they're thinking about, because like you say, we hear about risk, we hear about certainty or volatility. What is the key takeaway that you want your clients to just really get about this?
Love it. Love volatility. Well, listen, if share markets had the volatility of cash, they'd have the return of cash.
Yeah.
The reason you get paid in share markets, the reason as an investor I can expect a return is because I'm willing to take price uncertainty, right? That's the trade we're making, right? Someone wants cash, I have cash. I'm going to trade my cash, which is certain, for their shares in their business, which is uncertain. Well, if I'm going to acquire shares in their business, they're going to have to offer them at a price which is attractive to me because I had the certainty of cash to start with, right? Mm-hmm. And they do that by offering those where I can buy a business that has an expectation of profit that's going to give me a return. Now, I know that it doesn't always work out that way every time. That's why you diversify. So the uncertainty of the market is the reason why you get the return as an investor. So if you want returns, you got to get your head around the fact that price uncertainty is not my enemy. It's probably my friend as long as I take it within a responsible fashion, which is why I talk to an advisor so I can understand that.
Yeah, I think that's the key, is finding the right mix for the investor. And a lot of people probably haven't assessed their own risk for a while. I think during COVID, a lot of people got a bit panicked about it, and there was a lot of switching going on, and unfortunately some people didn't switch back, and then they miss out on the recovery. But
I heard no success stories of people switching.
No,
yeah, it's always the wrong way.
Yeah, absolutely. And so timing the market's terrible. It's time in the market. Idea. That's the old adage. But I think if you're watching this video, the key takeaway you want to get out of it is go and assess do a risk profile, check your Kiwisaver, see if it's taking the appropriate amount of risk. If you want to go through that with an advisor, obviously you've got my details, but even if you just do it yourself through your provider, it's worthwhile doing periodically, and take on Ben's words around the returns you're going to get at the end of the day.
And I really like, we were talking about this off air actually a couple of weeks ago now, I think it was, and you just said, risk, just swap that word out for volatility. What's your volatility profile? Do you care tomorrow? No, I don't. Do you care in 30 years' time? Yes, I do. Cool. That's your volatility and timeline.
Yeah. I sometimes use the 1994 test. Right. So 30 years ago was 1994.
I don't believe you.
do you really care? Do you really care what the volatility of returns were in 1994? Right? Does that have any relation to your spending or whatever else today? Yet how you invest it, if you want to spend today and you're of that age to spend, your investment profile in 1994 had a lot to do with your success or ability to spend now. Like, it just doesn't matter. Right? 30 years ago, right? So if you're thinking, if let's say you're 35 years old in your 30s, like, you're going to be spending in the 2050s. You are just not going to care by the time you spend what the volatility was in the 2020s. It will not matter to you. Your portfolio will be worth multiples of what it is now if you had discipline, you diversified appropriately, you got an advisor, and you understood what you're trying to achieve.
Yeah. Incredible. I'm with Grant on this, though. Your maths must be wrong. 1994 is not that long ago. Thanks so much. I hope you enjoyed watching this, and there's more in the series. So again, if you want to connect with Ben or Grant, their details will be in close proximity to where you're either watching or listening to this. Thank you very much. Welcome to Sidekick TV. I'm your host, Ric Thorpe. Sidekick TV is the place for Kiwi business owners and entrepreneurs to learn all about finance, accounting, and how to run and operate a business in New Zealand. We're going to interview experts from the finance realm and fellow Kiwi business owners. Stay tuned.